Good morning, everybody. Wonderful to see you all. And what we're going to do is we will just get straight into the presentation. And today, as John told us, we're going to be looking at cash versus profit, an extremely important concept within business, within accounting, and clearly something that we all need to be aware of. Now, whenever we start talking about business and the purpose or function of businesses, guys, I'm pretty sure we'd probably all agree that profit is what we talk about. If you look here in the middle of the page, we've got a quote from Milton Friedman, a very famous economist. And as far as Milton Friedman is concerned, there is only one responsibility for people in business, and that is the maximization of profits. And we can understand that. If you look at some of the headings that are posted around here, we've got in the top left some concern about Tesla, Elon Musk's famous electric car company, and their major issues with struggling to profit. If you look in the middle of that quote, you'll see that Tesla themselves had a $1 billion loss in 2018. Absolutely crazy. If we consider Amazon in the top right corner and Zoom in the bottom right corner, both of these companies, well, we're using Zoom right now, guys, and their profits have been absolutely soaring during the COVID-19 outbreak, as of course have Amazon's. And at the bottom left-hand corner, operating profit of 76 million for an unnamed company. And we're going to look at that in just a second. But what you can clearly see, folks, is that the most important thing, as far as most companies are concerned, is their profit. Well, we can understand that because it is the reward for people's risk, yes? But let's just consider that quote in the bottom left-hand corner. Leading to an operating profit of 76 million. Well, what leads to an operating profit? I'm sure most of you are aware that profit is the result of our revenues minus our costs. And if we move on in the presentation, we'll see the full quote listed at the top of the screen now. And the full quote for a company called J.D. Wetherspoons, which is a retail pub chain selling alcoholic drinks, etc. in the UK. Their total revenues for the 26 weeks leading up to the posting of this article were 933 million, and that led to their operating profit of 76 million pounds for that period. But what I'd like to consider is, of course, the difference between their revenues of 930 million and their profit of 76. Because what the difference is of course their cost. And as you can see from my first bullet point there, guys, 856 million in cost. And that's not an annual figure. That's half a year, 26 weeks. That means that it's approximately 5 million pounds sterling a day in cost generated by this company. 5 million a day. That is a lot of cost to cover. And of course, we have to cover these costs with cash. Because as you can see there, we have a phrase that I'm using, a burden of daily debt. We have a daily debt to pay of 5 million pounds. Where does this money come from? Where do we get 5 million a day? Well, usually it comes from our revenues. It comes from our customers coming into our stores, whether they be online or whether they be a retail store on the high street or a shopping mall. But what happens if they don't pay? What happens if our customers don't come to us anymore? What happens if there is a short-term break in demand for our product, as is the case right now for many firms in COVID-19? well, then we have a real issue, don't we? We have a real problem, because if you cannot pay your costs, then there are significant consequences. And there's a number of consequences for each of the stakeholders, as the individuals that are interested in business, whenever we have a non-payment. Let's think about some of these in a fairly straightforward kind of manner, guys. If we were to think about our employees, what might happen if our employees were not to be paid? Well, they'll simply not work for us. And if they don't work for us, how do we generate value for our customers? Because as much as entrepreneurs and businessmen and women, as much as we are the ones who put our heart and our brains and our ideas into our company, we must have the employees to do the work, yes? The same with our suppliers. Failure to pay our suppliers, the consequence of non-payment is that they will quite simply not supply us. Same for a bank. If we fail to pay, they won't lend us any money. And what about the government? An incredibly powerful stakeholder, guys, that may have an extreme level of interest in your firm. And if we stop paying the government, and if we remember what we pay the government is tax, if we stop paying our tax, I'm pretty sure the government would have something to say about that. But one consequence I would like us to consider involves this hospital here. We don't really think of hospitals being a consequence of businesses not paying, or their customers not paying them. But this was the case for one particular firm, for a particular firm known as Carillion. And we're going to talk about the collapse of this firm, Carillion, which you should be looking at a newspaper article now. And unfortunately, just before lockdown, just before in the UK when we locked down, a couple of weeks prior to it, construction work began again at what is being called a super hospital, the Midland Metropolitan University Hospital. Now, it was due to be opened 2 years ago in 2018, but unfortunately, the construction firm, and I'm sure we're all familiar with what construction firms do, the firm Carillion collapsed. It went away. And as a result, the hospital is expected in February 2020. In February, it was expected to be delivered by 2022, 4 years after it was due to open. And as you can see from the paragraph I'm just highlighting there, the sort of the second to last line, at double the original cost. This is a massive issue. Carillion did not receive payment from its customers. As a result, Carillion could not pay its suppliers and it could not survive. One significant consequence of this was this hospital could not be built and now is 4 years late at double the original cost. And indeed, if you look at the very final part with the bolding that I've added of that screen, it says that the costs are likely to reach nearly £1 billion. £1 billion. With 0.7 of a billion, or £700 million being funded by the taxpayer. Now, of course, when we're talking about a hospital, guys, there are major issues. This means that ill and very sick patients have not been receiving the treatment and the specialist services that this hospital could have provided. You may notice as well that the name says University Hospital, Midland Metropolitan University Hospital. And what this also means is that there has been a 4-year delay on medical students receiving training in this super hospital. Significant consequences. So what I'd like to do in our discussion of cash versus profit today, I'd like to look at this company Carillion and the circumstances surrounding its collapse. Now, the first thing to consider is, who were Carillion as a company? Were they a socially responsible construction firm? Well, as you can see here from a newspaper article headline, Carillion left a school looking like the Somme. I'm sure you might be familiar, but the Somme is a very famous World War I battlefield in France, which I'm pretty sure we don't want our schools to look like. And over here, we could consider, were Carillion just one victim of government failure? That's the UK government failing to act properly. Well, that is an issue that we must evaluate and think for ourselves. So we're going to look at this in a bit more detail now. We're going to consider, what did they do? Well, Carillion were involved in a really broad range of public services, which means their customer was the government, the UK government, and arguably everyone that lives and works in the UK. This means that Carillion is a very big and very important company. You can see from the image on the right from the BBC News that Carillion not only maintained the homes, which means they cleaned and fixed the homes of 50,000 UK military personnel. They provided school meals to over 200 different UK schools. They built hospitals, as we've just seen a couple of slides back, but they also built roads and rail transportation networks, including being awarded in 2017, which is a significant year, as we'll see in a few minutes. In 2017, they were also awarded a £1.4 billion contract to run what is known as HS2. That's this bottom one down here. And as you can see from the infographics image, that is a rail network. It is high-speed HS, high-speed rail network, which is due to connect the north of the UK to the south of the UK. This is a huge contract. And that is not all that Carillion were involved in. The scale of their operations was absolutely massive. You should be looking now at a map of the UK, and you can see some of the costs of their incredible projects. Up in the very top right corner of this map, you'll see that in Scotland, part of the UK, you'll see that there is a £0.7 billion road being built. A £700 million road. Across to the centre, mid, you'll see the two hospitals, including the Midland Metropolitan University, which we were just talking about, as well as the Royal Liverpool Hospital. Both of these projects over 300 million. Now, between the Aberdeen bypass, the road in Scotland at 700 million, and the two hospitals also totaling 700 million, we can see a massive, massive amount of revenue for this company. 1.4 billion in revenues just from these three projects. But as you can see from the map, that is not the only projects that these guys were involved with. They also expanded overseas and won very lucrative contracts in Dubai and the Middle East, including responsibility for building entire sections of the world's famous Dubai Expo, which obviously being delivered in 2020 is not a great year. Now, as Carillion were involved in so many projects, and if we add them together to think about a cumulative, which means putting everything together, if we add a cumulative burden of debt, to use that phrase I used earlier today, guys, we can see a significant problem. Carillion were trying to do too much. They have extensive public services in the UK, because as well as building a road that bypassed a major city, and a number of cities, in fact, in Scotland, as well as building hospitals, building sections of the Dubai Expo, and a number of different Middle Eastern projects in a number of different countries, as well as maintaining prisons, 50 different prisons they were building and maintaining, hundreds of schools they were providing school services like meals to, tens of thousands of military personnel. This is an extremely busy business. Now, what was the impact then of all of that business? Well, let's have a look at some things. Well, as you can see in bold in the top bullet point, they were able to pay record dividends of 79 million pounds to their shareholders in June of 2017. They also paid significant performance bonuses to their board of directors and a number of significant senior executives. These figures were in the hundreds of thousands to dozens and dozens of individuals, adding up to millions and millions of pounds in performance bonuses. Now, very important, guys, is the difference between the date, the 10th of June, and what happened on the 10th of July, just 1 month later, in the third bullet point on my screen, guys. So you can see clearly that from June to July, there has been a significant change in performance. Record dividends. Oh, so happy. This is fantastic news. But then 1 month later, they had to announce via what's known as a profit warning, which is given to business analysts and to the market. They had to announce to the global market, as a responsible public limited company, they had to announce to the market that they were having a reduction of 845 million pounds in profit. And as a timeline, just 2 months later, in September of the same year, there was another reduction. Profit going down, profit going down. Look at that figure, guys. That is £1 billion. £1 billion. There's a real problem with this company, yes? Going from June, where they were able to pay out 79 million in dividends, which is, as I'm sure you're aware, that is a profit share that is allocated to the shareholders. And once that's gone to those guys, we must be thinking that in June 2017, we're thinking that this company, in fact, this company must be, in June, we're thinking this company is a fantastic performer. We're thinking that the impact of their business activity, all of these things which I showed you here, we're thinking that those are extremely positive things. And yet 1 month later, 1/4 of a year later, just 3 months, we're looking at £1 billion reduction in profits. The company is telling us they are not making a lot of money. There is going to be a real problem. And this problem, of course, compounded and came to light in early January of 2018, when the company went into liquidation. Now, I'm not sure if we understand what liquidation means, but effectively, the company owns a number of buildings and machinery, equipment, which we refer to as assets. Here is a very crude drawing of a building, and a number of buildings, in fact, that the company owns. To liquidate them means to melt them down into cash, or to liquefy. I'm sure many of you have done science and you're aware of the states of matter, and obviously we move from solids to liquids. Well, that's exactly what we do when we liquidate a business. We move from a solid asset and we turn it into something that is liquid, and that is cash, because cash can be used for anything. Except there was a very big problem, guys. As I'm sure you've already skipped ahead and seen, they owned very little. They had debts of £7 billion. 7 billion. That's 7,000 million. But they only had 29 out of the 7,000 that they owed. As a percent, they were able to pay 0.4 of their debts. Now, when we're measuring efficiency in business, we would suggest that a company should be able to pay at least 150% of its debts. This is the ideal liquidity for a firm, 150% to 200%. What we actually are experiencing is a company that cannot pay even 1% of its debts. This is, of course, a very significant problem, and one that Carillion found utterly impossible to actually get over. Now, if we have a look down here at the very final point on my slide, guys, you'll see that £2 billion was owed to around about 30,000 different suppliers and contractors. It was always paying them late. It was a notorious late payer. It constantly tried to manage its cash flow by never paying the people that it owed money to. It did not have a good reputation. Unfortunately, as the company only had 29 million, it was never going to be able to pay the £2 million owed to its suppliers. And the result of Carillion's business activity was not just that Carillion went bankrupt, but a number of its suppliers did as well. And this is so significant, guys, remember, because of the kind of things that Carillion was doing. We are not talking about customers unable to get an iPhone. We are not talking about a fashion brand that means we can't buy the latest sunglasses or sneakers. We're talking about a business that builds hospitals. It couldn't continue to build those hospitals, and it couldn't continue to pay its suppliers. This is, of course, a major, major problem for us, guys. We're not happy about this. So let's look and let's see if we can establish, where did it all go wrong for this company? Because if you look at this diagram that's on your screens now, guys, you can see that Carillion's revenue, which is their income, as I'm sure you know, is measured in the billions. Consistent year after year after year after year, 4 to 5 billion in sales. Their income was extremely good. Extremely good. And of course, the reality is that as over time, as labeled T on that graph there, over time, their sales were growing. And that's fantastic. Of course it is. But that doesn't necessarily mean that their cash, oh, yellow was a poor choice of color, Andy. Come on now. Doesn't mean that their cash was growing at the same rate. And we're going to look at why this happened in just a little minute. So how was it that cash killed the king or queen? We're not sexist here. So how did cash finish off this business? There's a number of reasons, a broad number of reasons. But for the purposes of today's session, we're just going to consider two factors that had a significant impact on destroying this business. Well, number one, late and partial payment given by Carillion's customers. But one of the most significant factors here is that the payment comes in after Carillion has actually had to pay for necessary factors of production. And again, for those of you that are not familiar with factors of production, I'm sure you are, but the factors of production include labor, they include land, they include the capital requirements, and in Carillion's case, we're referring to significant capital expenditure on equipment because they're building things, and they're not just building a house. They're building huge, huge projects, roads, bridges, prisons, hospitals. Therefore, the equipment required costs a lot of money. They have to pay for very specialist labor. They have to fund land. And only after Carillion have paid for these things did they receive payment. And what we find actually is that these payments were late and sometimes incomplete. That's what partial means, incomplete. And then the second major issue that affected Carillion is something that we call overtrading. Now, overtrading is something that you would not encounter in the first year of studying A-levels at Abbey College, but is in fact something that you would encounter in the second year of your A-level studies. But it's not a hugely complex idea, and it's very important to what we're talking about today. So I'd like to give you a sample of it. What I'd like to do now is look at each of these two factors, and this will again remind us of the importance of cash more than profit. So let's consider cash flow. Well, cash flow refers to money coming into the business and of course money flowing out of the business. And what is left we refer to as a net cash flow. And in a very simple fashion, in minus out is equal to net cash flow. But in a very practical term, what we need is we need money in before money goes out. Because what we need to do really is manipulate what we call the cash flow cycle. Now, I'm not going to go through it in full detail, guys, because we only have a limited amount of time. But essentially, it's really important that we never use our own money. We like to manipulate. Now, manipulation generally has quite a negative reputation, and manipulation is generally seen of as not a good thing. But when we're manipulating cash flow, then we're doing something good. So what we want to happen is this section here, this arrow that I'm just deleting, we want to delete it, this one here. And what we want to do is we want to buy our goods on credit. We want to transform them using labor that we pay at the end of a month. We want to transport it to our consumer within that time period, and we want them to pay us before we have to pay for our supplies and our labor. And in this way, we never use our own cash. This is recorded, I know John said, so you guys could always watch it back if you want to recap on that idea. But effectively, what it looks like is this. What it looks like is a situation, and again, we're just keeping this as simple as possible for now, So I've given an extreme example. I'm just going to change it over to something nice and transparent. If we look at the money coming in, you'll notice that throughout the year, this company has no money coming in until we get to the end of the month, the end of the year, when 100 comes in. But the problem, of course, is the money going out throughout the year, as you can see, guys, is considerable. Every month, there are things to pay. There are burdens of debt, as we've referred to earlier. The issue then is that slowly but surely, the business has a negative bank balance. And that negative bank balance eventually becomes minus 73. Now, that doesn't seem like a lot of money. But of course, very simply, what if we were to suggest that all of this was in millions? And now we're suggesting at this point in November, the firm needs to somehow have minus 73 million pounds in their bank. Well, we're going to need to talk to our banks. We're going to need our bank to effectively give us 73 million pounds. Now, of course, our bank will want us to pay this back, yes? Of course. But what does our bank see coming in? Nothing. For the entire year, we're telling our bank that nothing is going to come in. And they have to have faith in us that we will get some money coming in later. They have to believe that in December, we're going to receive 100 million pounds. Because otherwise, they would give us 73 million and they will never see it back. And this represents an extreme degree of bank risk. An extreme, oops, my screen was slightly laggy there, sorry guys. An extreme degree of bank risk. So they're unlikely to do that. And again, that was the case for Carillion. They were not allowed to use their bank facilities because the bank didn't believe that money would come in. So their cash flow was a major issue for them. Okay, now that second issue we identified as overtrading. Overtrading is, of course, as I said, an A2 or a second year A-level concept, but effectively it simply happens when a business tries to grow too fast without having the money to back up that situation. And I think this first bullet point, guys, is really, really important. It does not matter if your company is profitable. Overtrading can lead to business failure because it is a capital, a working capital issue, a cash issue. Now, I've highlighted two of the most significant causes of overtrading, guys. The first is that our growth is achieved by investing a large amount into various pieces of capital, building a hospital, maintaining a prison, building a road, a railway. We have to put a lot of money in before we're going to get money out. And I know what the phrase is, and you've probably heard it too. We have to speculate in order to accumulate. We have to put our money at risk, put our capital at risk before we can get a return. And that is generally true. But with cash, if we do not have enough cash, we will be crippled. Because we link into the second point, if we have these significant costs before payments are made by our customers, then we need to find the cash from somewhere. Because if we cannot pay our suppliers, our debtors, everybody that we owe money to, they will not allow us to continue to operate. So let's look very quickly at how we could have reduced the risk of overtrading. Well, actually, the best thing to do is just everything that we would normally do as part of a sensible cash flow management in a business. And it's this second bullet point that I'd really like us to focus our thoughts on. A couple of slides back, I suggested that overtrading could simply be referred to as greed. Now, I know this is an odd one for the head of business to be talking about in a sample lesson, that we should not be too greedy. After all, we're all here to learn about commerce and to learn about how we can generate profits and financial freedom and things. But if we're too greedy, if we try and grow too fast, we will not make it to the end goal. The end goal is profit. Don't get me wrong. This whole talk, profit is the end goal. But we will not reach the end game if we do not have the cash to keep us going. Yeah? And that's the point of this talk, guys. And we're coming towards the end. We're going to have a little look at how we might examine this question and some other reading that you might want to look at. But before we do that, the key evaluation for us here in what is more important, cash or profit, we know that profit is the purpose of a business. Of course it is. It's why we exist. It's the risk that we take to generate. But it is cash that keeps us alive. And without cash, even this profitable business, remember, Carillion was paying out 79 million in dividends. That's profit for PLCs to shareholders. Carillion had 5 billion, that's 5,000 million pounds in revenues. What did this mean? Well, in economic terms, this means that there was significant demand. There was sales happening. Customers wanted these products, these services, these hospitals to be built. Of course they did. Every government needs roads and railways and prisons and hospitals and schools. Of course, every government does. Therefore, the demand was there. 5 billion pounds worth of demand year after year. But unfortunately, they tried to do too much. They tried to do too much. And the result, something that I'd like you guys to all remember, is that we must never, when you guys are running your own companies in the future, never underestimate the value of cash. And I don't mean physically holding cash in your pocket. I reach into my pockets right now. I've got no cash in my pockets. Of course not. But I have cash in the bank. And a business needs cash in the bank because it will not survive if it doesn't have it. Now, that's the end of the theory side. But as part of a sample lesson, of course, we need to consider how we might look at the assessment for such a topic. Okay? Now, this kind of topic would typically be assessed in an exam through an essay. And an essay is largely designed to test your ability to evaluate something. And I'm sure you're aware, but an evaluation means that we need to make a judgment about something. We need to analyze, firstly, which looks at both sides. And in our case, we're talking today about cash versus profit, which is more important. So we would have to analyze both sides. We would consider the reasons why cash is more important. We would consider the reasons why profit is more important before we would arrive finally at stage 2. We would arrive at a judgment. We would make a decision about which we believe is more important. So I've given a sample question here. in the blue box. To what extent, which simply means how much. How much do you agree that it is inevitable for companies like Carillion, such as means like, which means it is not limited to. So I would be encouraging my A-level students to be bringing in examples from outside of this case study. If today we've been focused on Carillion as our case study, I would want my students to tell me about Amazon. And I would want my students to tell me how Jeff Bezos of Amazon ran Amazon with no profit for over 10 years because he managed the cash, because he had significant investments to make in building the Amazon infrastructure, and how now Jeff Bezos is one of, arguably the, by most measures, wealthiest man on the planet. He's made his profit in the long term. I'd like to know about that. I'd like to know how overtrading could be avoided. So you might link in Amazon. You might also bring in Warren Buffett. If you guys don't know the name Warren Buffett's a very famous investor. Now, he does own a company, and his company is one of the most valuable companies on the planet. But Warren Buffett says that anybody, you, and me, we could all do what he does. But the problem is no one wants to get rich slowly. That's what Buffett says. No one wants to get rich slowly. We all want to get rich quick. And that's a significant problem because overtrading. We try and do too much. We blow up and we don't make it. So I would want my business students, when they see phrases like such as Carillion, I would like them to explore and not just limit themselves to talking about the business in the question. I would like them to form arguments on both sides. For example, before we form our arguments, we have to consider the words in the question. The first up is the phrase inevitable, as highlighted in red there. Now, what does inevitable mean? As a word, it means that no matter what you do, it will happen. To put this word into context, there may be many of you in the room that are familiar with the Marvel movie, The Avengers and the Infinity War. I'm a big fan. But within that, the main bad guy, Thanos, you can Google this if you're unfamiliar. I'm pretty sure you will be familiar. But the main bad guy, Thanos, states that he is inevitable. That no matter what you do, you cannot change destiny. It will happen. And that is what inevitable means. You cannot stop it. It will happen. Now, in the blue box is a very important concept for all of our A-level students, whether they're studying business or economics. We need to be familiar with the term evaluative hook. A hook is something that holds things, yes? Well, this entire question is held by the word inevitable. That is the single thing that you are arguing around. Is it inevitable? Will it always happen that firms like Carillion overtrade? And you need an argument, yes, they will overtrade. And you need an argument that says, no, they will not always overtrade. So let's look at what two of those arguments might be, guys, before we finish. Well, one argument that says, no, it is not inevitable, because within companies like Carillion, there were choices made. They did not have to try and win a contract for the Dubai Expo. They did not have to try and win a contract with the UK government for the new high-speed rail service or the hospitals that they were building. They could have not tried to sell to those customers. But that is down to the leadership of a company. And the CEO at that time, Richard Howson believed that it was the right thing to do. But what if the company was not run by Richard? Or if the company was run by me or you? Then maybe we would have made different choices. Therefore, it is not inevitable that every company will overtrade. That's one argument. Looking at the other side of the argument, however, we could say that it doesn't matter if it was you, or me running that company. It would happen. It is inevitable. It's inevitable because companies like Carillion are PLCs, which means they are public limited companies, as I'm sure most of you know. And what this means is that they are quoted or sold their shares on the stock exchange. Again, I know you probably already know this. It's just a good reminder. And of course, that means they have shareholders. And shareholders buy effectively for two reasons. One is for what we call capital gain. And capital gain is the idea that over time, the value of the shares will increase. And therefore, if we buy at point A and sell at point B, we will have made a gain of the difference between the two. And the second reason is for dividends, which we mentioned earlier. Carillion paid out a record dividends of 79 million in order to satisfy its shareholders. Whichever way you look at it, capital gain is long-term profit. Dividend is short-term profit. Whichever way you look at it, shareholders want profit, and we're greedy. Every year, we want greater amounts of profit. Every year. And this is the concept known as shareholder primacy. We believe that we should put our shareholders as the number one priority in every company. And as you can see from this Financial Times article, and again, the hyperlink is there, and I know John's going to send this out to you guys. So if you're interested, you can click on that hyperlink and have a read of the article. Not right now, though. Try and stay in the room. Now, shareholder primacy is central. What it means is it is the main problem for the way we govern or manage our companies. And it even cites Carillion in the title there. They offer lessons to us in the danger of focusing only on giving our shareholders profit instead of sensibly managing our business and doing what Warren Buffett said and getting rich slowly. So those are two arguments. And it would then be up to you to form a good conclusion as to whether you believe, no, it was not inevitable, or yes, it was inevitable. Now, if you want to read a little bit more about shareholder primacy and corporate governance, one thing that we do encourage our students to do on a regular basis is to read around the subject. Now, this is quite a short book by an ex-Harvard student and well-renowned business author called Lynn Stout. And The Shareholder Value Myth is a book that I highly recommend students read in the discussion between cash and profit. For the last 45 minutes, guys, I have told you that cash is super important. And Lynn Stout in this book, The Shareholder Value Myth, is going to explain why, for investors and corporations, They currently believe that profit is the most important, but that is a wrong or poor view to take. And the idea is that short-termism will lead to a real business tragedy, as we've seen today. We've seen today in the discussion of cash versus profit that cash is so important, because without cash, critical businesses like Carillion, who look after schools and hospitals and roads, will fail if they are led poorly. And I view it as my job, and the job of you as students coming potentially to Abbey College, Cambridge, it's our job to look at the future and build business in the way that we know is responsible for society. Because whether we believe it or not, whether we agree with Milton Friedman from the very start of our video, we do have a responsibility to the societies that we operate in. When John sends out the slides, guys, there's a whole bunch of additional information that follows on the next slides. Now, I'm not going to go through those there. I'm going to finish now, and I believe there may be some questions either for John or for myself or for Jalal. So please, thank you very much for listening today. And if you do have any questions at all, I'd love to hear them, whether they're for myself or for John. So I'm going to stop sharing my screen right now and just talk to you guys. And if you have any questions, or if John, if you'd like to take over, please do so.
Hi, Andy. Yeah, thank you for that a really interesting and informative session. Please do post any questions, guys, that you have now for Andy, and I'll put those to him. We have one question here from Lei Fen, who's asked if when a student answers that question, the example question that you gave, if they were to only use Carillion in their answer and not mention any of the other companies, how would that affect their marks?
It's a great question. It's a really insightful question. Thank you very much for it. It would limit marks. The exam board, and at Abbey College we use AQA, and at other exam boards the same situation applies. What happens is a student's answer is graded in bands of levels, level 1, 2, 3, 4, and 5. A student that only spoke about Carillion would still achieve either a level 4 or a level 5 response, but the chance of them achieving a level 5 response would be extremely limited. Every year the exam board puts out guidance for its examiners, and it instructs the examiners that, quote unquote, the very best students will reference broadly outside of the case study. So the very best students. What this is a clear instruction from the exam board that you must encourage a broader view outside of just Carillion in our example in order to achieve the very top marks. Now, this particular essay could be worth 20 marks or potentially 25 marks. For a student that only spoke about Carillion but did everything else fantastically well, as I'm sure you would, being coached by us at Abbey Cambridge, then that student might achieve anywhere up to 21 out of the 25 marks. But for the very top mark band, they're unlikely to get anything above 21. Now that would still be worth an A star, but what we try and encourage students to do is to manage their risk. And the risk is that you got a different question wrong. So you want to maximize the marks wherever you possibly can. And by bringing in examples from around the world of different businesses, you can maximize those marks. And Leifen, this is something that we would be doing at Abbey. We encourage students every week. I bring in the news. We use Twitter extensively to bring it in, and we talk a lot about what happens around the world. So we try and keep our students up to date, but we strongly advise them to read around the subject. And year after year, I've been with Abbey for 5 years now, and year after year, this is what we see. And Leifen, I'm glad you've learned a lot and had a good session today. Okay, thanks.
Brilliant. Thank you, Andy. Just following on from that, really. So to contextualize the work that you guys do with students, how much emphasis do you put on working with students to understand the context of the question and really break it down as you did? I mean, how important is that for students to learn?
It's hugely important, John. Hugely important. So we would spend. I would suggest that what I've provided today is a true sample. We've probably spent half of the time talking about the theoretical side, but it's all been in the context of a business. And every time we deliver something to a student, whether it's learning about break-even analysis, whether it's learning about returns on investment or leadership styles, marketing, everything is in the context of a business. So whenever we deliver something, it's always contextualized. I would say it's 50-50, because without context and without understanding, our students would only have knowledge. And I'm sure far more knowledgeable men than I, wiser men than I, have been quoted as saying, without understanding, knowledge means nothing. So we have to have the understanding.
Thanks, Andy. And I suppose it's also important that students practice under kind of exam conditions as well, because it's very easy to, if you panic in a question, to not read it properly and not understand exactly what the exam board is asking from you. So I suppose it's important that you have these kind of practice and past paper tests that students can build up that experience of.
Yeah, hugely. So I would say on a weekly basis, students will be writing essays in context, and on a half-termly basis, so every 6 weeks or so, students will be sitting either shorter in-class tests or more significant tests or exams outside of the classroom in the main exam hall, in order to get acclimatized and to practice how to respond under pressure. That's very, very important. And most of the homeworks that I actually set will also be with a guidance to be completed under timed conditions. It is so important to get used to the conditions that you operate in. It's why top sports teams go and travel to the location of, World Cups, etc., before they're playing, weeks before, to get used to the weather, to get used to the climate, to get used to the conditions. And that's exactly the same for you guys. We're looking at top performance here, and top performance only comes with practice. Practice truly does make perfect.
Thanks, Andy. And obviously you talked a little bit about students reading around the subject and bringing in those kind of experiences and up-to-date knowledge. Do you think extracurricular clubs as well feed into that? Can students take advantage of the opportunities that we have to sort of, contextualize the subject, but also make them attractive candidates?
Yes, absolutely. I would hate to try and quote the number of extracurricular clubs that we run at Abbey. I think it's probably around 50 to 70. It might be more. I'm sure Phil White could provide more information on that. But being able to participate in these clubs really puts you in a room with people that are passionate about. There's a bit of a meme, a bit of a cliche saying going around that says your network is your net worth. Your network is your net worth. So you need to be in a network of people that are equally passionate about the things that you are interested in. And that's true whether you're at Abbey College, Cambridge, or elsewhere. You must surround yourself with people that love the things that you love, because it will push all of you forward to achieving so much more. And you will understand so much more of what's going on in the classroom by pushing your understanding and your knowledge to new levels through either the economics club or any of the business investment clubs that we offer, so that you can truly understand what I'm saying in the classroom and how it actually applies in the real world. It's a huge benefit, John, huge benefit.
Brilliant. I think that makes a lot of sense from a business perspective. The final question from me, Andy, was just kind of, in your experience as kind of the head of business and commerce, for business students, if we're looking at business studies, what sort of subjects do you find that students will take in combination with business, and what kind of university destinations and courses do you find that students from Abbey Cambridge are looking to target?
Thanks, John. So typically, our students within business will study maths, potentially further maths, as well as economics or accounting. That tends to be the most popular combination. So we typically see business, economics, accounting, and maths, potentially with further maths instead of either accounting or economics. That said, we do have a number of students who have a specific focus already in mind for their career. So for example, we have a number of engineers who study business with us. So they will be studying business, further maths, and physics, because the further maths and physics gets them through to the position that they want to be in for university to study engineering, but the business is there because they recognize that in the future they will be leaders in their field. And it doesn't matter what that field is, they will be involved in a commercial environment, a business environment. So we can very typically see business with maths and then another subject, either pure economics or accounting for the financially minded students, or for those with a particular field in mind, they might look at physics or chemistry, potentially even politics as well, for those looking to move into public service. In terms of universities, we will typically see our students, all Abbey students, aim for the very highest of universities, the best universities they can possibly get into. So we will typically see students looking to get into the LSE from our business and commerce sort of faculty with our economics and accounting and business specialisms. So they'll typically be looking at G5 universities, including a preference for the LSE, Imperial College, and UCL, as well as a number of other colleges through some of our foundation programs in terms of Durham, potentially Manchester, Bath, and King's College came London as well.
Thank you, Andy. Sorry, I lost my mic there. Yeah, that's great. And I think, you know, in the modern world, you see so many people from technical backgrounds, whether that's in engineering or computing, starting businesses and being incredibly successful. So I think that makes a lot of sense that students are looking to combine, you know, technical subjects with business as well, because they understand that that's where they want their careers to go in the long term. So it definitely makes a lot of sense, and it's a great head start. Thank you for your answers, and thank you for your presentation today. I can't see any more questions, so I presume that we've answered all your questions, but please do, when you receive the presentation, when you receive the video, please do, if you have any questions, post them, respond, and we will put them either to Andy or the business team at the college to get back to you and to answer. But thank you very much, Andy. I think I'll let you say goodbye, and then we'll finish things off.
All right, fantastic, guys. I hope you've enjoyed it. It's been a real pleasure, and I really hope to see some of you perhaps at Abbey College in the near future.
Brilliant. Thank you very much, everyone. Have a lovely afternoon or evening wherever you are. Bye-bye.